purposes of this scenario, this is not going to come as a shock. I'm going to be Jean Darnell.
And my name is Giovanni Albertanza. I'm a partner at a firm called Rosenberg Martin Greenberg in Baltimore. I focus on tax controversy, and for today, I will be playing the created part of General Counsel for Delos.
And I should say that I'm going to be playing Lee McNally, so I am from your firm, and in theory should be asking questions that should help you.
Okay. Thank you very much. We are here to just present our findings from the problems that you presented. We decided to present the findings in order of most tax consequences to fewest tax consequences, just to give you a better idea of impact and scope of the different issues. Okay. So Christine will be starting by presenting information on the foreign tax consequences of the Tax Cuts and Jobs Act on HPCO's activities abroad. She will then continue on to Robert Ford's compensation agreement, and then I will take over with the reorganization and the consolidated returns. To help you follow along, we've presented some materials for you to go along with. We'll be going through we'll be pulling out the slides as we get to them, and they'll also have the key tax code sections we're referring to referenced on them. And with that, I'll turn that over to Christine.
Thank you, Kasia. Mr. McNally, Ms. Darnell, Mr. Gio, our General Counsel, thank you for allowing us to present today. We are delighted to be here. As Kasia said, we're going to start with the implications that the TCJA, the Tax Cut and Jobs Act, had on controlled foreign corporations. And as you know, you have a controlled foreign corporation, HPCO, host personality company, and Delos owns 100% of HPCO, so these definitely apply. And the reason that these changes were made primarily was to move the U.S. into more of a or the intent was at least to move it into a territorial tax system. And that is so that the taxes are paid within its own, are generated within its own borders. And so if you would turn the page, please, we're going to start with slide number 3. And prior to the Tax Cut and Jobs Act, the income that was generated by HPCO was not subject to any kind of a U.S. tax until it would come back into the United States in the form of dividends. So as far as 2017 is concerned, you will have zero tax implications because these now take effect beginning in 2018, these next slides. So in slide number 4, we're going to talk about the first issue, which is section 965. And 965 is actually a retrospective tax. It is on income earned by your controlled foreign corporation as of post-1986. And now the $100 million a year that you have paid to HPCO for the use of their intellectual property, the artificial intelligence for your theme parks, is now going to be subject to 965 taxation. So you began paying them in 2010. That means that you have $18 million total as of December 31st, 2017. And the way that...
You mean 800, I think it's 800 million.
I'm sorry, 800 million,
sure,
yes,
of course,
thank you so much.
Not a problem.
Thank you.
We liked 18 million better.
Yes, I'm sorry, it is 800 million. It's 2018 is the year, 800 million is the dollar amount. Thank you very much for that clarification. So the way that this is going to work is that you're going to have a tax imposed on 8% of your illiquid assets and 15.5% of your liquid assets. The reasoning being that the assumption is if you have not distributed that money back to your U.S. shareholders, it's been in your either in your accumulated earnings and invested, or it's been invested into some of those assets of your company. And so that's the reason for those taxation implications. So what this translates to is a tax that could range from 64 million to 124 million, depending on the composition of your assets.
So, for example, if it's 64 million, which looks a lot better, what are you assuming there in terms of the comp?
We are assuming that most of your assets have been, or excuse me, yes, the investment of that has been in your illiquid assets, so not sitting in cash and investments.
Okay. Okay.
Any other questions concerning 965?
No.
Right, then let's move on and turn the page, please, to page 3.
Mm-hmm.
And we're going to start with slide 5. Now, whereas 965 is a retrospective tax, GILTI, or the Global Intangible Low Taxed Income, is going to be a prospective tax for income earned after December 31st, 2017. Now, GILTI is a little bit more of a complicated tax, and what it is going to be a tax that's going to be imposed on your income, but there are certain benefits because you are a C corporation. So GILTI is calculated as your $100 million income, and it's going to be able to have 10% of your qualified business assets, which are valued at $50 million, net $50 million after you deduct your depreciation. 10% of your qualified business assets would equal then $5 million. 100 million times the $5 million gives you a taxable GILTI income of $95 million. Now, because you're a C corporation, the normal tax rate would be 21%, but you will get a deduction of half of that. That will move that down to a 10.5% tax rate. This is going to result in $9.975 million beginning in 2018.
So what you're telling me is I might owe 124 million, and then I may owe $9.9 million
That's correct,
going
Ms.
forward.
That's correct, Ms. Darnell. And at the end of this presentation, we have summarized all these numbers into one table so that you may look at it in one single page versus in these different pieces.
You know, that seems an awful lot of money to pay just because of this new tax law. Do you have any suggestions about how I can avoid that?
The GILTI specifically, because really there's nothing with 965 since it's retrospective. There are a few things that you could do. One is you could increase the amount of the tangible assets that you have, and so that would increase your QBI deduction. Again, you can look at the ownership of HPCO because this is on companies that are controlled foreign corporations. So there are some suggestions we potentially could have for you should you want to move this forward.
Okay, thank you.
When you say look at the ownership, what exactly do you mean?
I'm actually gonna, are you prepared to talk to that, Kasia?
So with the tax applies to companies that are 50% or more owned by you. So if you reduce below that, the tax would not apply at that point.
Okay. But this is the critical, intangible property of this business, so.
Yeah, I mean with the only thing would be to potentially move it from being a foreign corporation to move it to be in the United States. But then you do have, you're not subject to tax in the foreign jurisdiction, so you'd probably still be subject to additional U.S. taxes if you did that. So there might not be a great workaround on that.
All right, please continue.
Okay. So the final one that we're going to look at, if you look at the number 6, is BEAT. And that is a base erosion and anti-abuse tax. And based on the information you've given us, we're really not sure about a number with that. But BEAT, I will give you a summary of what BEAT is. BEAT is for companies that have over $500 million per year over an average of 3 years in receipts. And you certainly do, as a corporation, you have $10 billion. And the next thing we're going to look at is what percentage of that income that you are, that you're paying to HPCO, which is $100 million a year. That's a tax deduction to you. And so if that $100 million is actually more than 3% of your total deductions, then you may be subject to the BEAT tax. We do not know what your total deductions are, so we could not calculate that. But it would be that if your total deductions are less than $3.3 billion, potentially you could be subject to the beat tax.
So you're saying we could pay 124 million plus 10 million plus whatever beat could be. I mean, that's a lot of money for us to pay in 1 year. We weren't prepared for that. So is there any help we can get with this?
So here's the good news. Once you've paid this, then it's 100% dividend deduction for the company. So all of that is viewed as being repatriated back into the United States. So you're not going to have any more tax consequences, at least to that extent, if you pay the shareholders the dividend off that 100 million.
Is the 124 due this year? Do I have to pay that this year?
No, so that's another very good point. So under the 965, you do have up to 8 years to pay that. You could pay it this year. So the 965, section 965, where the greatest amount of this is occurring, you do have up to 8 years, and the amount that you have to pay is in a staggered payment schedule of the percentage of it that can be paid. The guilty will be paid this year.
Okay, thanks.
Yes, thank you.
Sure.
If there's a problem with the beat, is there anything that could be done to mitigate that?
I think I'll turn this over to Kasia. Would you like to address that, Kasia?
Yeah, I think for the beat, we would just need a lot more information about your deductions and what your current tax liability is, because the calculation with the information we had was just not possible to run, to be able to be calculated.
Okay, but
I don't
if it turned out that these payments push the company into a beat posture, is there something that you would recommend doing?
Well, again, if I don't, may I jump in? The thing is, one of the things is that if the company makes deductible payments to a foreign subsidiary with a greater than 25% U.S. ownership, so we could look into it and see if there's something that we could do with this definition.
Thank you.
So if there aren't any more questions concerning the foreign tax corporations, we'll go ahead and move on to the next potentially substantial issue for you, and that's Robert Ford's compensation package under section 162. If you would turn to page 4 and look at slide 7, that's where we'll start to talk about it. So 162M has applied to covered employees for publicly traded companies, and Delos is a privately held company, so in 2017 before, that hasn't necessarily been a problem, but the Tax Cut and Jobs Act has now changed the definition of that to include privately held companies that have publicly traded debt, and Delos does have publicly traded debt, so now it will fall under the 162M provisions of covered employees. And so if we go into slide 8, we can start to talk about what's a covered employee. And under the Tax Cut and Jobs Act, that definition has now been expanded as well. And it includes the CEO, CFO, and any of the 3 top highly compensated employees at any time during that year. It used to be at the end of the year, and now it covers all the way till the end of the year. So that is an issue. Robert Ford did leave before the end of the year, but that's not relevant. Now, the other question we have is if he would fit one of these definitions. He was the founder, and so we are not necessarily sure that he does fit, but given his compensation package and his founder status, we'd assume that that may be the case. And so if you turn, please, to page 5, we'll look at slide 9 and discuss the next issue. The code did allow for a grandfather clause. So if you had binding written agreements, which you did with Robert Ford, that were in effect at the time and not materially altered before November 2nd, 2017, that potentially could have been grandfathered in. Now, the other issue which we also must address is whether his compensation in this agreement was considered an ordinary and necessary and reasonable expense given the amount of the millions that we're talking about. And there is some case law with F-Star Management Company that said that we would have to give real careful scrutiny as to whether or not this is ordinary, necessary, and reasonable. So that is another issue which you may have to prove. But if we can meet all of these criteria, then there's a potential we could grandfather it. The problem is that on 12/20/2017, we signed an agreement with Robert Ford to extend this deferred compensation until his 75th birthday.
Mhm.
And along with that, you added another $5 million to that contract.
Mhm.
And so a question would come into play is whether that $5 million is a material modification. Now, on deferred compensation, if that amount can be tied to a normal rate of investment or a normal return, it's potentially not a material alteration, or a modification, so we would have to look at that.
When you say a normal rate of return on a type of investment, what are you meaning there? What does that mean to you?
Well, if you look at, first of all, we don't know how old Robert Ford is right now.
Right.
We don't know how far away his 75th birthday is.
Right.
And so we also aren't really sure at what what that might look like, but we could look at what the present value is and maybe a discounting and look at what type of return we might expect if we could know certainly his age and that kind of an information.
Okay.
And so, what we're looking at in slide 10 is that in 2017, Delos was not publicly traded, so the compensation may be deductible if it can be proved that it is ordinary, necessary, and reasonable. And then 2018 and beyond, we are looking at whether the grandfather clause is viable. And I'm going to actually turn and let Kasia talk about the last little bit under 409A and some options that we might have with those larger payments.
Sure. Thank you, Christine. So there is a provision under the regulations for Section 409A that would allow us to defer the payment that you're making to Robert Ford in 2018 from his deferred compensation agreement. Defer it if you can't deduct it because of Section 162M. It's not a perfect fit. It was written under a prior change to the tax code, so it doesn't perfectly fit these circumstances. But what it could do is it could allow you to defer an additional $1 million at least of his revenue if you delayed that payment until 2019 instead of 2018. So the net effect of that would be is if we can count the contract to be materially altered, there would be the 2018 pay that you're paying him is already $1 million, so that would be deductible under 162. I mean, you wouldn't have to. You could make that deduction. You could delay the 2018 compensation payment to 2019, but you would have the remaining income that would be taxable in that year or not deductible in that year of $24 million. And then his future payment in either 2022 or at his 75th birthday, he would need to. That would only be deductible up to $1 million, unless that change wasn't a material change, and then only the additional $5 million would be, only the additional $5 million would be subject to the 162M modification, 162M $1 million limit, so $4 million of that would have to be not deducted.
Okay.
And then we did also verify that you can make if Robert Ford is allowed to make the change to his compensation plan, the only thing to be aware of is there are rules around when that deferral can be made within 409A rules. So if he elects to defer his payment from 2022 to his 75th birthday, the deferral has to be for at least 5 years, and it can't be he must request it before 12 months before that payment is due to him. So there's just certain rules to be aware of if he is making that election.
Okay. Well, it seems like we've covered that pretty well. And just to confirm, we can take all 52 million in 17, right? That was your conclusion?
Yes.
Okay, all right.
But may I, you want to make sure that it's necessary, ordinary, and reasonable. That would be the only thing that you may have to kind of argue with this.
Service on whether or not that is
Just curious, do you think a $50 million staggered deferred compensation payment on a company that has revenue of at least $10 billion a year is reasonable? What do you think?
I'm not really sure that I would like to comment on that right now. I would have to know more information before I would want to give you that kind of advice.
Okay, good enough. Good.
Thank you.
All right, well, then I will move on to the reorganization issue. We're now at slide 11 in the handout. On there, on slide 11, we just got the structure of the organization pre and post reorganization. With the reorganization, so that is something that we can would qualify as a reorganization under both sections D and F of the tax code, but which would qualify most of the transaction for tax-free treatment. The D reorganization, because it also qualifies as an F reorganization, we have to use the F reorganization as the reorganization type under the regulations. So the F reorganization is a mere change in identity, form, or place, or incorporation. So that's really all you're doing here is changing Wyatt from being incorporated in California to being incorporated in Delaware, and you're spinning off those B assets to Sweetwater Partnership. The transfer of those B assets, unfortunately, is going to be taxable. Because it under the way that it's considered is it's considered as a transaction that occurs before the reorganization takes place. So it doesn't disrupt the F-type reorganization, but it's counted as a separate transaction. So with the property being distributed, what that would mean is if you turn your attention to slide 12, we do have most of the transfer of assets happening as a tax-free reorganization, including the transfer of the Business A assets to the new Wyatt organization and the receipt of Newco stock by Wyatt and Sweetwater's receipt of the new Wyatt stock and Wyatt's receipt of the Business A assets from Wyatt Company. The taxable event is it's treated as a sale of Business B assets at fair market value to your shareholder. So what that means, that's taxable both to Sweetwater and to Wyatt. Sweetwater gets a $7 million taxable dividend, and their basis in Wyatt Inc. is reduced to $13 million under Section 301C and 312.
How are you getting to 7? I'm curious.
Absolutely.
Talk me through that.
Sure. So the way I'm getting to 7 is there is an interim. Let me start over.
It's fine. Take your time.
Wyatt's earnings and profits are at $3 million.
Yep.
And there's a gain on the sale of the assets. That's $4 million.
For B, right?
From,
Assets B. Okay.
So
got it. Yep.
that's added into the ENP before the distribution is made. Then you have $7 million in ENP before the distribution. That $7 million is a taxable dividend. The remaining $2 million, the fair market value was $9 million, will be a reduction to your stock basis in Wyatt.
And what is the cost of taking that dividend into income?
Absolutely. So the cost of taking that dividend into income is, so Sweetwater does not pay a tax. It's a partnership, so it isn't directly taxed. Host and Midco are the companies, are the corporate partners of Sweetwater Partnership. That dividend is passed on to them and is then taxable to them. They, as corporations, they can take a dividends received deduction under that will under 243, and what that means is they can deduct 65% of that dividend received. That results in $2.45 million being taxed of the distribution, which is at a 21% rate is $514,500. And then there's a separate tax to Wyatt on the sale of the assets. So they have had $4 million in taxable gain just based on their basis and then current fair market value, which results in $840,000 in tax.
Okay, so we're now up to 134.4 million of tax. So I'm gonna need a beverage after this meeting.
Yeah, unfortunately, the taxes are piling up.
Plus the beat, whatever the beat
Is there a way to do better than that?
Yeah, that's.
Sure. I mean, so thank you for asking.
When you're answering that question, we just have.
We have 5 more minutes, yeah.
Okay,
Yeah.
we'll go through this quickly, and I'll cover the reorganization shortly. So the one solution would be if you kept the business fee assets with Wyatt, it would be part of the reorganization. You wouldn't have any taxable issues with that. The only other way we considered is if Sweetwater was a corporation, so if it was an association taxed as a corporation, which may have its own tax consequences that we may need to look into separately. If they were a corporation, they would get 100% dividends received deduction, which would eliminate that $500,000 in tax.
I want to let you move on to the NOL, because why wouldn't you be able to talk about that in the last few minutes? Good, that's good.
Okay.
All right, so we have the NOL. So do I have any hope on the NOL? Give me something, Kasia.
Unfortunately, Ms. Darnell, I don't think I have good news for you here either.
Drink is now a double. Go ahead.
So the Tax Cuts and Jobs Act eliminated the ability of net operating losses to be carried back. So while Wyatt does, while the new Wyatt entity does accede to the old Wyatt entity's net operating loss because it was an F or reorganization, it can't use that to count against 2017 income. It can use it indefinitely to offset 2018 income, so it could offset some of the, it could offset Wyatt's 2018 income and beyond. The other problem is that Wyatt is not going to be included, is properly excluded from your consolidated returns because Wyatt is owned by Sweetwater Partnership, which is a partnership not eligible to be included on a corporate consolidated return. So a corporate consolidated return will only have it only consists of corporations that are 80% or more owned by a common corporate parent. So if you look at slide 13, we just got a quick image there of the corporations that are, or the entities that are excluded on your organization chart from being on the consolidated return. That's HPCO, because as a foreign corporation, it can't be included. Sweetwater Partnership and Wyatt would be the two that would also be excluded. The potential solution to getting Sweetwater and Wyatt excluded or included would be as for having them elect to be taxed as an association taxed as a
There
corporation.
should be a partnership.
I'm sure there's reasons.
But there might be other tax reasons that may not make sense.
Okay, all right. Good enough. I think you have a minute and 30 seconds. Is there any other solution? Because
If you'd like to turn to the final page,
yes.
8, and it does give you, unfortunately or fortunately, the low end and the high end of what the tax implications.
Now, wait a second, I love this. Look at this column that says low and zero.
Well,
Now, Christine, you tell me, how do we get this column, make this work for me, right here? $6.50 an hour you're charging me, come on.
Well, unfortunately, there's no way to get around from your 965, as you can see,
Yeah.
because it's a retrospective. And beat, we're not sure. We're going to try to keep that $100 million underneath that 3%. We're looking at the 162M and really hoping that that's not a material modification on Robert Ford's contract, that we can have a deductibility.
Mhm.
The F reorg, we are looking at whether or not that you can, with the partnerships and as Kasia mentioned,
Mhm.
turning those into corporations. And did you want to add on the corporation? And let's see, we've got the guilty
How
tax.
do I get that to 0? What's your plan to get me to 0 there?
On the guilty tax,
Yeah.
let me go back here and look at that. I guess if we can, maybe we're going to look at moving HPCO into
The
whether-
US?
into the US.
Is there any concern because it's developed IP over the years? What are we worried about there?
Do you have
It
a
says,
comment on
according to
that?
the facts, it looks like we contributed some IP, but then we put all that robot stuff, if the robot moves and then it blinks and then it starts, walking up to people, all that new stuff is there. What's that, what are we worried about there? Anything? Is that okay? You just bring that all back?
Bells are ringing in my head, but I'm not sure which code section I need to be referring to.
Well, you told me, Bill, so I guess I gotta put a footnote by that. All right. Okay, we're good. Thank you very much.
Thank you.